If you want to understand where parts of the economy are headed next, don't start with earnings reports. Start with the new SNAP rules rolling out across multiple states. At first glance, this looks like social policy, food assistance, work requirements, administrative changes. But if you care about markets, consumer behavior, or long-term economic shifts, this deserves your attention. Because this isn't just about benefits. It's about capital flow. SNAP supports more than 40 million Americans. That translates into tens of billions of dollars moving directly into grocery stores, supermarkets, and retailers every single year. And unlike many other forms of government spending, this money doesn't sit idle. It gets spent immediately. That makes it economically powerful. Now several states, including Idaho, Oklahoma, Louisiana, Indiana, Iowa, Nebraska, Utah, and West Virginia, are tightening rules. Some are restricting certain purchases, like soda and candy. Others are expanding work requirements to reduce eligibility over time. Let's break down why this matters from an investing perspective. First, product mix. If certain high-margin items become ineligible under SNAP in some states, that changes what people buy. Grocery stores don't just care about revenue. They care about margin composition. Sugary beverages and processed snacks often carry stronger margins than staple goods. If spending shifts toward basics like produce, dairy, and grains, retailers may still see sales, but profitability per transaction could look different. Second, participation levels. Expanded work requirements could gradually reduce the number of recipients. That means less guaranteed monthly spending flowing into specific communities. Lower-income households tend to spend nearly every dollar they receive. When benefits shrink, consumption reacts quickly. That can impact discount retailers, dollar stores, and regional grocery chains disproportionately exposed to SNAP-heavy markets. This isn't about dramatic collapse. It's about incremental pressure, and markets move on incremental changes long before headlines catch up. Third, geographic divergence. Not all states are implementing changes at the same pace or in the same way. That creates uneven economic conditions across regions. Retailers with heavy exposure to certain states may experience different demand patterns than competitors operating elsewhere. Municipal budgets could also feel strain if administrative costs shift more heavily to states. That has implications for municipal bond investors and state-level fiscal outlooks. Policy changes rarely affect the economy evenly. They create pockets of risk and pockets of opportunity. Finally, the long-term lens. There is a broader argument that restricting certain low nutrition purchases could lead to improved public health outcomes over time. If that happens, even marginally, it influences healthcare spending, workforce productivity, and long-term economic output. Those effects don't show up next quarter, but long-term investors understand that structural shifts compound. So what's the takeaway? When you hear about SNAP rule changes, don't just hear policy. Hear shifting incentives. Hear altered consumption patterns. Hear changes in predictable spending streams. Because investing isn't just about watching earnings reports. It's about understanding what drives those earnings before they show up on a spreadsheet. When government policy changes the rules around billions of dollars in consumer spending, markets eventually respond. The investors who pay attention early are the ones who position themselves intelligently, and the ones who dismiss it as just policy usually notice it after the numbers move. That's the difference between reacting to markets and anticipating them.